Thank you for joining us for another For Investors by Investors Long Beach-Cerritos podcast. As always, we're proud to be your all-education real estate resource without any kind of sales pitch. If you'd like to attend one of our meetings in person, we meet on the last Thursday of each month at the Cerritos Library in Cerritos, California. You can RSVP at meetup.com/for investors by investors. To find more investment resources such as blogs and podcasts and content from other FIBI groups, go to forinvestorsbyinvestors.com and search our entire library. Now on to the podcast. So if you want to find any of our chapters, you can go to meetup.com and type in FIBI, and you'll make sure you put the distance as unlimited, and then you'll find all of our chapters throughout Southern California. And all those chapters are run the same way with no sales pitch atmosphere and really just trying to help each other out and be the relationships that we need in this business, because we can't do it without each other. And this has really been the entire point of FIBI as a whole. And I can tell you that networking like this has exploded my business. It explodes so many of the people's business that come here every single month just to network and go to multiple events like this to learn. So thank you guys very much for joining us here. We have Mike Monge over here that is actually a full-time private money lender and has as a professional doing this and has a business doing it. Is very, very knowledgeable. I'm excited to have him here. And then we have Raymond Tai, which basically helps us with the group, is running the group with me and is a full-time realtor and broker, and basically helps with anybody in the what kind of areas? All over here, right?
All over here.
Okay. And last year he had some pretty amazing volume too, so I'm always impressed by people who do volume because it's so much work, it's crazy. So that being said, we don't make a lot of money at these events. We pretty much break even on an annual basis, and so we bring in some sponsors that I feel are really quality people that actually come in and help us with these events and come in and help us with money to be able to continue to do these things. We are a nonprofit organization, so the first one is actually Trillion Capital that basically Mike is the owner of, and you guys want to say something about we don't have the thing up here, it's all for features.
I just like looking at pictures of myself.
Yeah, no, don't worry. So you want to tell us a little bit about Trillion?
Yeah, so Trillion, we're a hard money lender. We specialize entirely in California. We have offices in Northern California and Southern California. Most of our business is fix and flip financing. We do new construction. We do bridge loans. We do multifamily apartment financing. We're fast, reliable. We pride ourselves in kind of being your consultant to give you a second look at your property. We'll tell you if we think it's a dog. And if we think we're going to lose money, we'll at least have a heart-to-heart with you and say, hey, why do you think you're going to make money on this? We think you aren't, and here's why. And we're not always right about that. So sometimes after I talk to the borrower, I go, I didn't take that into account. So, but we really focus on wanting to be like a partner, because it's just a much better business model for us to establish relationships who come back again and again and again, rather than I do one loan with you and you decide you're going to go someplace else because you weren't happy with the experience. So,
yeah.
And I also work with Karen Moore in the back. She's in the very back.
Thank you. Appreciate it. Some of our other sponsors, anybody from Hart King here? So Hart King is a law firm that sponsors our club, does a lot of my real estate contracts, and helps out with a lot of different operational structures and operating agreements and things like that for us. We also have New Western Acquisition. Anybody here from New Western? So New Western is a wholesaler on crack. So they basically wholesale like crazy here in Southern California and do a ton of volume. So I think he had mentioned to me they were having some really big six-figure months consistently, which is pretty crazy when you're talking about wholesaling. So we have UDirect IRA. Anybody here from UDirect? See, it's raining. All of our sponsors decided to stay at home. So UDirect IRA Services is a self-directed IRA custodian that basically helps people self-direct their retirement into pretty much any asset class that you have an interest in investing in, aside from life insurance, collectibles, and things like that. But I have a lot of investor clients of mine that invest their capital from their retirement accounts into real estate or notes or multifamily or syndications, and so it's a great strategy to utilize when you're investing. We also have Concept 360. Can you guys get up and tell us? They are a property management firm here, based in Long Beach, and do all of Southern California area for the most part. Can you guys get up and tell us a little bit more about what you guys do? Will and Robin?
Yeah, my name is Robin Reed. We own a property management company in Long Beach called Concept 360, and we specialize in single-family homes and multifamily homes. We do South Bay, Orange County, this area right here in Long Beach, and yeah, we've been doing it for a long time. And property management is a really key piece to, especially when you get more and more investments. So, if you have any questions at all about property management, let us know.
It's the key to successful investments when you're talking about owning rentals and things like that. It's the most important part for efficiency purposes. So, that being said, we also have the Note Assistance Program. Jasmine, Natasha, stand up. Come on up here for a second. I absolutely love these girls. They're going to make me tired one day with their notes.
Yes.
So tell us a little bit about what you guys got going.
So this weekend, last minute, February 23rd and 24th, we've got a 2-day event at the Crown Plaza. Are you guys familiar with the Crown Plaza by LAX?
Yeah.
All right.
Yes,
Business.
we do non-performing banknotes. So we teach you how to do it, and if inventory is a problem for you, it's not a problem for us. So come find, get our inventory, access to it, and we'll help you create diversity in your portfolio.
And so Matt's been to the class before. I think he's attending again in April. So that's my second class in April. July. I'm just teaching there. I will be there this weekend for sure. So if you guys have time, I think we have 4 tickets left. We keep it to 50 people so that you guys can learn and we can really, drill down what you need to get from the class. So this weekend, we'll be here. So if you want to find out more, talk about it. But the class is up from 9 to 6, Saturday and Sunday. 2 days, we're going to talk about how to buy notes for banks.
How do you want to come talk to you guys afterwards or something like that?
Yeah, we'll be in the back here for the rest of the evening, so come and talk to us if you're looking to sign up or just find out more, okay? I know we were talking to Clint earlier, so we're friendly, right?
I actually felt like the class was really valuable. They go over the details of like note investing and the paperwork involved, which is really how you protect yourself, is that paperwork. And they invest in notes full time, but they don't want to invest with people that aren't educated on this because it makes them look bad to the banks and things like that. So they do this a lot of times to develop different investors and show them how to invest in notes and to be able to do business with them a lot. And you don't want to be doing business with people that are uneducated when it comes to their paperwork and money, because you end up with lots of crazy people and surprises afterwards.
Exactly.
Take it from my experience dealing with crazy people, so.
Thanks.
But thank you guys.
Thank you.
Whenever I find it's really valuable, like I'm going to a class pretty soon on note investing as well, and then I actually went to one probably 6 years ago that changed my entire way I do business. It adds just another tool to the tool belt. So all these different strategies that you hear about are extremely important, whether it's investing in multifamily, if it's learning about property management, whether it's understanding the note business or raising private money and raising capital, especially here in California, which is very concerning if you don't have the right licenses, if you're not set up correctly, if you're raising private money from investors. It's really important to understand the intricacies of this stuff, and that's really what we're here for, and why we bring in experts like Mike here to come in and help with this, because I learned from it as well, and it's great for me. Could you imagine every month being here consistently at 2 a month in FIBI South Bay? We have 3 different speakers. Here we usually have 1 or 2 or sometimes 3, and you're just learning from all these amazing professionals that honestly just move your business forward tenfold. And the more you learn about these things, the more successful you'll be. And who was I talking? Where's Patty at? I was talking with Patty earlier today about some financial planners that I was talking with, and they were telling me that 80 to 90% of the people they meet don't have any financial plan at all, don't have any understanding of where they're going to be with their money. And a lot of times they're 50 years old, 60 years old, 70 years old and still working and things like that. And it's a big, big epidemic and a problem. And so what we do here at FIBI is try to educate as much as we can on the financial side, on everything we can. We don't care about the trade secrets and all that stuff. It's all BS, okay? The trade secrets are get your butt out there and work really hard and make mistakes and lose money in different ways. And if somebody tells you that they've never lost money in real estate, they're either lying to you or inexperienced, one of the two. So because, you lose money in different ways. There's lots of ways to lose. So that's why it's important to learn from the experts that have already lost that money, and so you don't have to as much. So that being said, Mike, can you give us a little bit about your personal background? I know you talked about Trillion Financial and what you guys do a little bit. Can you talk about your personal experience and what you've done, in the past?
Yeah, I was thinking of the Talking Heads song where he says, "Well, how did I get here?" So I. In my early 20s, I got involved. I ended up in California. A friend of mine, when I was getting started in my career, he was in the middle of the downturn. It was the downturn in the late 80s. And he said basically he hated everybody that he worked with. And they needed to hire somebody in their department as a commercial real estate developer. So he says, I'm going to give you a script, and you're going to basically fake it till you make it and get in the company, which is what I did. I started off at the ground level, a commercial real estate developer. I did that for a couple of years, and the market was still kind of bouncing around the bottom, and they were still laying people off within that company. It didn't feel very secure. And the funny thing was, the guy that brought me in, he quit, so then that was like job security for me. I got promoted, then I became Employee of the Year. But I still felt insecure. So I answered a blind ad. This was back before the internet. There was a blind ad in the newspaper. And what it was, and I didn't even know what that even meant. It was essentially a real estate hedge fund. And what their niche was they put in the mezzanine financing for subdivision development. So a private home builder, privately owned home builder, entrepreneurial home builder, not like a KB or one of these big brand names. Say, I'm going to build 100 homes in Irvine, or I'm going to build 100 homes in Corona. I'm going to go out and get a construction loan, and I'm going to go to Mike's Hedge Fund, the company I work for, to put up the equity piece. So it'd be similar to when you're buying a house, you get a mortgage, and you got to come up with your 20% or your 10% or whatever that is. So they would come to us to put up that 20% piece, and then we would split that 90-10 with the builder. So whatever that 20% was, we'd put up 90% of that piece, builder had 10% in, and then we'd split profits. So he'd build out 100 homes, and if they made money at the end of the 2 or 3 years, then we'd split profits 50-50. They're like a real simple program. Awesome. There was derivations of that where we lent money doing that. But I came on as a junior analyst. I worked myself up over like 5 or 7 years to become running my own office. Got transferred to Denver, Colorado. Ran an office there. I missed California so much. After about 6 years, I came back here just in time for the real estate market to crash. And that obliterated everybody. So essentially, we were in the riskiest piece of that asset. We were in the equity piece. And so our worst case scenario was if prices fell 20%, you're going to get wiped out. Well, prices dropped 30, 40, 50% in some places. So it was like an atom bomb had gone off. And essentially, there were no companies doing what I did. So for about a 5-year period, I wandered the desert. That's kind of only half true, half joking. But the most interesting experience that came out of that is I worked for the FDIC for about a year and a half. And I got on these teams that were closing the banks down that were failing. So that was a whole other story. But as the market started to get better, I entered. Sorry, that might have been me.
No, it's there.
One of my coworkers that I worked in that the venture capital with, he'd started Trillion, and he was running it by himself. And after about 5 years, he'd grown to the point where he's like, hey, how would you like to come work for me? And he brought me a couple people in, and that's how I ended up there. So I just took all that experience I had doing before, and now it's, we're instead of doing 100 homes, we're doing 1, 2, 3, and 4 at a time.
That's great. That's great. Raymond, tell us a little bit about your experience in detail and what you specialize in.
My story is not that. My early 20s was just a couple of years ago. So I started when I was 20 years old, and it's been about 12 years into residential real estate. And our niche is helping families do contingency sales, first-time home buyers, and also investors, flippers, or especially people who are looking for cash flows. So our company's mission statement is to help people achieve financial freedom through real estate. And we've been helping a lot of families finding their first deals, helping them analyzing it to make sure they're not losing money. And we have sold about 300 homes so far, and we're working to get more and more.
That's awesome. That's awesome. That's great. You specialize a lot in the marketing aspect of this as well, right? Internationally and bringing in a lot of international investors here and clients and things like that, right?
Yes.
So, which is definitely a fun way to do things, you know?
Exactly.
The international clients is a great niche to focus on because there's so many challenges with buying real estate and differences internationally compared to here. So,
yeah, here even in California, international buyers still feel they're buying so cheap. Just like me buying in Memphis.
Right.
That's their perspective. Yeah.
It's interesting. It's crazy what pricing differences there can be throughout the U.S., of course. But I urge you, if you go to out of state, don't buy the $15,000 house that they say needs $15,000 worth of work, which is not true, and is in the hood that makes $600 a month in rents. It does not really make that in rents. You lose your money. So in reality, I learned this the hard way. I've flipped over 700 houses. We flip about 5 a month right now out of state in Memphis, Little Rock, St. Louis. We lend about $10 million worth of capital out to different flippers in different markets around the country. And those other markets I mentioned, plus North Carolina, Tampa, and Kansas City and things like that we're lending in. We have a turnkey system, and we own a management company and a brokerage on the ground out in Memphis. And then we also have some short-term rentals and do a lot of value-add multifamily projects, which is my primary focus moving forward, along with continuing the little single-family home system that I have going. So it's a lot of fun. I quit my CPA firm job in 2006, so I thought I was smart and I wasn't when the market tanked, and got slapped pretty hard myself, and just like everybody. But it really comes down to not quitting and picking yourself up and moving forward and not stopping and continuing to develop the relationships that help you move past adversity. So a lot of this business is adversity, where you run into spots where are really tough. And if you can maneuver and use relationships in that way to actually get you out of a tough spot, it really, really can be powerful to continue to get that base of different people that can help you. So and have the resources that you don't. So whether it's capital sources, whether it's time, whether it's finding deals, whether it's marketing and tech or accounting and legal support, all of the different team members that go around real estate are always extremely important and very difficult to find good ones because there's so many really bad ones out there. So you want to be really careful when you're doing that. So let's talk about raising money. Who here wants to raise money for their deals? Okay. Who here wants to raise money in California for their deals? Okay, so like everybody here. So who here actually has property in California? They found, okay, a lot less people. I'm surprised we actually got some more hands up to in California right now, it's very difficult to find those deals. Mike, what are some of the ways you're seeing some of your borrowers find their properties in this kind of a market to be able to get the kind of discounts that make sense for a flip in the first place?
Yeah, well, obviously, trying to find a property on the MLS that you could actually buy at a value that you can fix it up and resell it is almost impossible. I'm not going to say it's entirely impossible. It's really through a lot of networking. People that have been in business a while, they've got networks of real estate agents that they deal with, and they'll get first look at a lot of deals because the relationship is such that they'll resell the deal at the end of the day.
It is cut off. There it goes.
At the end of the day, with the same realtor. So once they've established a relationship where the realtor can trust them, then they will bring them more and more deals.
Okay. Hey guys, don't worry about it. It's cool. We'll be good. It's all good. You guys put the thing back up, and then is his mic not working? Did you guys turn that mic off?
I'll get it back on.
Okay, cool. Thanks. Yeah.
But we're seeing like now, like what a lot of probates. We're still seeing some foreclosures, and other people that have just literally been banging the, shaking the bushes for months and years, talking to people over and over again, and they finally get a call from that person that they've talked to and touched so many times. They said, "Oh yeah, I'm finally selling." So
it takes quite a bit. We do a lot of direct mail and pay-by-click marketing and things like that to try to find our deals, and it does take that 6-month sometimes hit on that person to get them to call you. You have people that put the postcards and everything into a folder for you later on until they get to the point where they really need somebody to come in and save them financially, or help them relocate, or there's a number of different issues that cause distress to find these types of deals. Mike, can you talk a little, go ahead.
And wholesalers too.
Wholesalers.
How often do you think we're doing, is there a wholesale involved, you think, Karen?
Probably at least 20%, 30%.
Okay, it's a good percentage. So if you guys are trying to find these deals, I would absolutely, before trying pay-by-click or direct mail or spending money on these things, go out there and develop 50 wholesaler relationships, 50 realtor relationships, and hit them up every 2 weeks or every week to constantly ask for properties. Keep them in your head. Give them a referral. Find ways of helping them any way you can. If you did that methodically, you will develop the relationships you need to do this, but it takes time. Right? Could take years to get tons of relationships, but if you do it methodically, you will find the inventory. And this is what we did initially in Memphis, and then we started doing the paid stuff afterwards because we realized that, okay, now we got a good system down. Now we know actually how to deal with the rehab in the first place, how to comp out properties correctly, how to do, all the things you lose money on. We stopped losing money on them and then started going into the paid stuff. So you can start with the paid stuff, but unless you have your systems down, you're probably going to be spinning your wheels, especially in California where on mailers you get like a 0.25% response rate on stuff. So you want to be really careful. So Mike, can you talk about like what one of those deals looks like a typical flip deal that you think is a good deal? That what kind of margin does it look like? What kind of typical rehab, or what are the different types of structures you're seeing? I know rehab is not anything but typical, but
yeah. So we're all over the map in terms of price points and loan amounts. So as long as we're in a mainstream market, Orange County, LA, Orange County, we'll do Inland Empire. We just don't want to be like in the distant markets. One, it's harder for us to service. So we never want to be in like the most, you could be in a Hollywood and you could be in like a multi-million-dollar loan, or you could be in Riverside in a several $100,000 loan, right? And what we just don't want to be is we don't want to be doing like the $1 million, the $2 million loan in Riverside. We want it to be appropriate, right? We never want to be.
You don't want a 35%, 40% drop again or more?
Yeah. So, in the old days, which was like 2-3 years ago, the flips were like pretty straightforward. There wasn't a lot of additions and so forth. Mm-hmm. And so somebody would come and say, hey, look, I just want to, this is a great old neighborhood. A lot of people want to live here, but this home was built in the 60s or the 50s or whenever it was built. I just, it needs to be just completely redone, and brought up to today's standards. So you're not necessarily moving walls around and so forth. In a typical loan like that, again, in terms of amount, it all depends on the neighborhood you're in. But, we lend on something like that. Our max loan amount is 70% of the after repaired value. We try to stay within 65-70% of what that finished property is going to sell for. We do our own internal evaluation. So when a borrower comes to us, they say, hey, we say, well, what do you think you're going to sell it for? And they tell us, and then we say, okay. And then we'll do our own analysis, see if we agree or disagree. But our max loan can go up to that 70%. So whatever that max loan amount is, then we start backing into what we can lend. So at a minimum, it's going to be 80% of the purchase price and then 100% of the rehab costs. But if we can push it to 85% of purchase or 90% of purchase and keep it within that 70%, then we have the ability to do that, if we like the other attributes of the deal. And on a loan like that, in terms of us, every lender's got a different pricing. They have different ways they price their loans. Ours is, we do points and interest. We don't have any add-on fees. We have no appraisal fees. There's no servicing. There's like no gotcha fees at all.
Interesting.
Right? We don't pay. You don't have to pay us to go out and do a loan draw. You don't have to pay us to service the loan. It's just points and interest.
And that's That's something that a lot of people don't understand. Is
Don't
all
understand,
the extra
right.
fees that are involved in a typical loan scenario, because the lender's got to pay for an appraisal. They got to, or a BPO or something.
Underwriter.
Yeah, the underwriter, the person that's going to go out and inspect the properties on rehab draws.
And we do it ourselves for us, that's why we have.
Yeah, and then if you can just make the money through the points or something like that, it helps a ton. It's clean, easy, and taken care of, right?
Sure, because everybody's deal structured a little bit differently, and so sometimes we've had customers that say, "Hey, well, these guys down the street, they're a little bit cheaper in points and interest," and then they'll come back to us later and say, "Oh yeah, but I didn't realize they had all these other fees," and they'll come back to us. So it's just something to ask when you're out there, but it's pretty straightforward. So. You close a deal like that, you've got to come to the table with your points out of pocket. You've got to come with that 20% and the points, and then whatever the escrow and title fees are. That's what you need to close the deal. Then you have to be able to pay interest out of pocket monthly on a monthly basis, and then you have to have some reserves to start that first stage of rehab, because the rehab dollars are funded on a reimbursement basis. So if the rehab was, say, $75,000. You're going to go out and do the first 10 or 15 or 20 grand. We're going to come out and see that you added value to the property, and then we're going to reimburse that. So you've got to have some working capital. As far as we're concerned, we don't care where that working capital comes from. We don't care where that down payment comes from. Some lenders do. Some lenders want to see the borrower has a minimum amount of money in. We don't care if you borrow 100%.
And that's great, because some lenders will go up to like 75% ARV, or some are down at 60% ARV. It really depends on the project in itself, because you have a big construction project with more risk. Okay, cool. If you have a big construction project with more risk and things like that, then there's a lot more risk for the lender involved in that kind of a situation. And so sometimes you get people that will walk away from you because of points, or maybe not a high enough LTV or something like that, but then they realize that it's not just about that. It's about reliability. It's about being there. It's about telling them, hey, don't do that project. It's not a good project. You shouldn't do it. You're too thin on your numbers, and your rehab is under budget compared to what it really should be. Because I get people in the Midwest telling me $15,000 rehabs, and I'm looking at the pictures, and I send my guy out there. I'm like, no, this is 40. You're completely out of your mind right now if you think you're going to get this done for 15, And so, and it happens all the time. Even the professionals will go through and mess that up sometimes, because they're going through and burning through these really fast sometimes, and sometimes they make those mistakes. And you're dealing with a lot of people that don't understand money sometimes. There might be the guy on the ground out there that is, going, talking to the homeowners, beating down doors, and, people don't teach financial education. So if you start flipping big construction projects, you better know how to manage your money. And so that's why it's really important what he's saying, where you have that money up front on a project. And, I realized very quickly my biggest risk was my borrowers not understanding how to manage their money correctly, So, and I think it's great to be able to allow a second position lender to come in that situation. As long as you have the exact money for the project that's going to be put in before your money gets put in as a lender, you are in great shape for that situation. And you should be looking at this from a borrower standpoint too. What does a lender need to see? What are the pieces of this for the structure? Can you give an example of maybe one of the last deals where they structured it without their own money, or a couple of last deals that you guys did, just so they can understand the pieces of that, or that aspect?
Yeah, and it's probably most of the deals we do. There's there's several ways you can do it. You could partner with somebody. You could put them on the loan. You can put on a title, and you could have your own LLC, or you could have two LLCs. You could have a partnership agreement outside of the actual borrowing entity per se, but it's just an agreement of who's going to contribute the capital, and then you're going to split profits in some fashion. So we don't get in the middle of negotiating that. That's really between the borrower to do that, right? So that's all between them. We don't get in the middle of that. But what we more typically see is they'll bring in, whether they call them a partner, and maybe they are a partner, but they will actually lend those dollars. And they'll put a deed of trust in second position. And sometimes they may have multiple. It could be a second and third, just as a way for that investor to secure the money that's being used in the property. So that if it's somehow mismanaged by the borrower, he's got some sort of recourse back to the property to try to get repaid.
So in the case that they run off the funds, like they misplace the funds, or they ran out before the project's finished, What do you guys do? Do you guys take over the project?
No, the funny thing is that never happens. So, yeah, I mean, it's not that uncommon. So the way we're set up is we're really closely held. We go out and we do our own site inspections. We don't farm it off to third parties.
That's great.
And I mean, through the whole process, whether you're dealing with Karen or you're dealing with me or you're dealing with other loan officers, you're pretty much dealing with a principal or a decision maker throughout the whole process. So we're going out consistently as the work's being done and we're releasing funds to reimburse for the work that's been completed. You start to see it up front. You can start to see, hey, there's some red flags here. They start asking for more money, then you're going, you haven't done that much work, and you can kind of tell. So then you just start asking more and more questions. And then in most cases, and we tell everybody, look, the best thing is just to be honest with us. Like, we can react to bad news if you tell us like right away. It's harder to react if you wait until like that molehill's turned into a mountain, and then you have to try to dig out of it. But we're very proactive in trying to work through it. So technically, if the borrower runs out of money, or if, let's say there's a budget bust, let's say it was a $100,000 rehab and the actual costs come in, they find something, they get into the project and they find, oh crap, there's a foundation problem, it's going to cost me another $30,000, I didn't budget that.
Right.
So technically that is the borrower's responsibility. Once that loan is set, we can't just go, oh, let's just throw another $30,000 into it. There are potentially ways that we might be able to do that, but we can't just recast that loan. We'd have to put our own second behind it, or we'd have to refinance it. And it's possible we could do that, but if the value of the property, the after repair value hasn't really increased, there may not be room for us to loan more dollars. So they're supposed to come out of pocket. So if it's $30,000, literally they're supposed to put that $30,000 in before we put in another dime, so that the loan's not out of balance. That's what we call it. But generally, what we do is say, okay, look, $30,000. We will say, okay, the budget's now 130 versus 100. We know you don't have the cash to come up with that. Let's see if we can fund on a pro rata basis. Solve the problem by funding on a pro rata basis. So maybe we're not going to fund 100% of each draw, or whatever that ratio is, the difference between what we're supposed to fund and what the new cost basis is. Maybe we're funding 70% of each draw. So rather than saying you've got to find $30,000 next week, or like the project's dead in the water, you got to find that $30,000 over the next.
Let them finish as much as they can,
exactly.
Slowly, right? Yeah.
So our goal is to help you get to the end of the line. And generally, people have a way to go out and find those extra dollars someplace. Maybe they go out and get a third. There's lots of different ways, but that's really the last thing we want to do is take that property back, because we're never going to come out ahead. If we take a property back, our best case, we're going to basically break even.
Yeah.
It's not, and it's just set up that way anyway. If we were to foreclose, if we can't really get paid, if that sells at auction, we can't get paid more than what we're owed. So any profits on top of that would go the next layer of lenders, and then ultimately back to the original borrower.
We do not want to flip properties. That's the difference with us.
Yeah.
We do not flip properties.
Yeah, and that's really important to understand, because there's vulture lenders out there that will be like, come on, I'm waiting for you just to mess up so I can grab that property. But finding somebody that actually goes and works with you and problem solves, that is really, really important, because there are problems that exist. And there are certain cases, like you're saying, where, if there's not enough equity, it's not like you as the lender or your lender is going to take that risk for you. They're not going to go change places for you and say, great, I'll just be in it for more money to finish that thing. They're going to do everything they can to make you find that extra money somehow, in any way possible. And last resort is foreclosure if you had to, but you still don't even want to do that. From a lender's perspective, you're almost like, can we find someone else that'll buy this from us and take that property and finish it, that has the money? But
because what we really want to see on the part of the borrower is, ultimately the borrower is responsible. And so we want them to step up and say, okay, I'm going to help you get to the end. And okay, we're going to help you get to the end. So at the end of the day, we want them to be as successful as possible. Even if they don't make money on that particular deal, try to minimize their losses. And we've lent to all kinds of people where we've filed NODs, and we lend to people that we've had issues and problems with. I had somebody ask me, So like, hey, I was late one month. I'm just talking about a late payment. So are you going to be able to do a loan with us in the future? We're like, yeah, of course we can.
Yeah.
So I mean, just the way we operate, it's really, we want a win-win situation. We really do. And we want you to come back. And, obviously it's, if there's a way for us to like help mitigate your losses and maybe we take a little bit of a haircut ourselves, where it's like everything's case by case specific. So it's hard to really say there's one way to do it. But as long as the borrower's engaged and really wants to, it's like
do what's right,
wants to help. I've had other people that said, "Look, I'm walking away."
Right.
At that point, there's nothing.
Yeah, at that point you're done.
Can I ask
Yeah,
you?
please.
So your original question was that, like, how do you mitigate or how do you keep from funding from misappropriating? It's because we do it on a reimbursement basis. So we go and check the value that we're about to give you is already in the property. So we're giving you back money to cover the value that we've added. So that's how we mitigate misuse of funds. We're not going to give them money for something that's not added to the property.
Okay.
So that's how we mitigate that.
But one thing I have seen is, even if that's going on and that's fine, I have seen, it's rare, but the borrower convinced the second to give them all of their equity up front to manage. Mm-hmm. So the second wasn't managing their money.
That happens a lot.
And then the second, and all of a sudden they stop paying interest. Well, why do you stop paying interest? And the second says, well, I gave all the money to the borrower. And the borrower had used it up however he used it up. So we're seeing the work's getting done, but he'd absorb more money from the second than what we actually reimburse. And
And that's important to understand. If you're a first position lender, I mean, you don't have a lot of risk by having a second in place because you're in first, but it does add a different risk profile. You realize that the borrower doesn't have as much money in this kind of a situation and, is less financially, stable. What do you think is an ideal borrower? What if you're talking about, capital reserves, like what kind of credit and, experience and all that kind of stuff? What do you focus on primarily when you're underwriting a borrower?
So for us, our borrowers are all over the map. I mean, we do first timers that have never done a flip before.
Okay.
And to be honest with you, the majority of our borrowers don't have a lot of cash reserves.
Okay.
So they have to go out and find that second, right? So we really are, our primary underwriting in terms of credit, we don't pull credit reports. We don't look at bank statements. Except on maybe if there's some rare circumstance, but on a typical loan, we're not looking at that stuff. What we're really looking at is, what is that property going to sell for when it's fixed up? And do I think these people can get it done? And if you can convince me to take a chance, I need to do that, and I trust you. I mean, we're meeting you, we're talking to you, we're walking the property with you. Mm-hmm. We're evaluating you the whole way through the process, right? It's not just on a phone. It's not just on the internet.
Are you paying? Are you being responsive?
Are you being responsive? Yeah. Do you have the answers?
Being there on time.
Yeah, right. Exactly. And if it's a first timer, I mean, we're really listening to what are you saying. What classes have you gone to? Have you mentored with anybody? Is this a simple flip or a complicated flip? If it's super complicated with like a big addition, say I don't know that I'm going to lend to you on this because I think this is way above your ability. And then they say, well, no, I'm going to partner with this general contractor who's done 100 of these homes, and I'm going to put up my money or whatever. But there's a mitigating factor.
Right.
So everyone is absolutely case specific. Depending on the experience level of the person, how complicated is the job? What's that margin of error? What if they don't pull off like a really good rehab? What's our risk there? What's our downside in terms of sales price?
I think that's important to understand too, is that rehab quality, is you want to be able to compare apples to apples. And there's so many different variations of those apples as well. On top of that, you're talking about, one rehab project that looks really nice and is amazing that hit all the metrics, or maybe there's 5 of them out there showing good comps. But if you don't do that same quality, or yours has a weird layout, or you go and use some cheaper material or something like that in the wrong area because you don't know the area, these are the types of things that your lender, professional lender is going to look out for you at and say, well, how is this rehab budget like this when I'm seeing these materials? Because a lot of the lenders understand what construction costs are because they're going through and financing these and seeing what it costs consistently. So it's really interesting when there's ways to mitigate this. So when people don't have the money and they're going after these seconds, who are they primarily getting them from? Where are you finding that they're getting most of their seconds from? Is it just other private lenders or professional lenders, or
It's
all of the
private
above?
lenders and families and friends.
Okay.
Yeah. If you ask me, hey, Mike, could you like point me in the direction of a second? I wouldn't be able to do it.
Okay.
I mean, there isn't like a trillion for seconds that I know. I get to ask this. I think I got asked this question earlier today. If I could tell you where to go, I
Right.
would. I don't. There's not like an institutional or
It's really risky loans.
Yeah,
These
right,
are
yeah.
above 70%, 75%
They
LTV.
know, like, and trust you. So even if they've done it for a million other people, you're new. So you can build that relationship.
Right.
And the other thing that we're really careful with is we like getting in the middle of that kind of a relationship and recommending somebody and like having that not work out. It's like it's a very fine line for us to, we're very clear to say, look, even if we do have someone we can refer, or we're very careful to tell our borrowers, like, this is a different company. This is not us. You need to do your own work, because God forbid that gap lender turns out to be shady or something, right? So we're very, very careful. You always got to do your own due diligence.
When you're dealing with these gap lenders and things like that, it's important to understand, your risk difference as well as a borrower in these kind of situations. You're talking about the first being a professional lender. The rates aren't super cheap or anything, but they're commensurate with the current market and good shape, but they're going to be there for you, like when you got to close in a week, or you got to close in 2 weeks, or even sometimes like less than that. Yeah, a day, when their wholesaler falls out and they're like, save my deal, I'm going to lose 40 grand if I don't close it. When you're there for them as a lender, that's what your important first position lender is going to be there for you. And when you add that second position lender involved, your risk goes up and your costs go up substantially, because typically that second position lender is going to take you to school on the rates. They're either going to joint venture partner with you and split it, which is really, really expensive, or they're going to lend you capital in this kind of a situation, which is also going to be pretty expensive too. So understanding how to protect those investors to decrease the rates or find those investors is really important. And you won't find them, especially the private ones that aren't professionals doing this with reasonable rates, unless you know how to protect them and understand the paperwork every step of the way. Mike, can you kind of talk about some of that paperwork? Like what are the documents that protect you as a lender? What are the main kind of pieces of this when you're originally doing a loan? And this is obviously the same for first and second for the most part, but what are those underlying documents to protect you?
So, I mean, the most important documents is your deed of trust, which is recorded. So that, as a lender, that just says, we've got the promissory note. It says you're borrowing $1 million from us for $500,000. You have the deed of trust that matches that attaches to the property, and we're in first position. So that gives us, the most control in the deal and the most important. Those are like the two most critical. We don't do a personal guarantee. We just don't really see. Because essentially
You're not going to get anything anyway.
we're not going to get anything anyway, and our recourse is to the property. But some lenders do a personal guarantee.
Most do, don't they? Do you find some?
I do a personal guarantee
Yeah.
pretty much every time, but yeah.
Especially in this market
But that's,
where you don't really know where it's going, but no personal guarantee is super valuable. If the sky falls, we're not taking your stuff, we just take
that's
the house.
yeah.
Where
But-
everyone else seems like.
But then,
they
like,
take your personal.
it's like the rest of the documents, they're all kind of ancillary. I mean, we have an environmental indemnity where the borrower just says, look, I'm indemnifying you in case there happens to be a hazardous waste site on the property. We have a holdback agreement that just says, hey, this is the amount that's in the holdback and how it's going to be distributed and so forth.
Okay.
But they're not really security documents. They're all kind of ancillary documents. So it's really primarily the deed.
underline the communication of what's happening.
Yeah, the deed
Right.
of trust, the promissory note. Some lenders will have a separate loan agreement. So sometimes title will say, hey, we need the copy of the loan agreement. We don't have a loan agreement. It's just the note, the deed of trust, and all those ancillary documents, yeah.
In the Midwest, and where they rent a lot of these properties, I'll actually go get an assignment of rents and leases as well on the property, because they're renting it out afterwards, and you don't want them collecting rent and just stop paying you and making you foreclose and that kind of stuff. So having that type of thing, I think, is important as well.
That's not-
Yeah, we actually,
it's not here.
that's
but-
actually built into one of our.
Oh, is
loans,
it?
yeah.
Okay, perfect, awesome. And understanding, hey, being able to explain to an investor, this is your deed of trust, this is what secures you against the property, this is your promissory note, this is the actual contract that you're signing that goes over the interest rate, the terms, all of the actual detail of what you're doing. And then, like she was mentioning, the personal guarantee, a lot of times they'll make you have the capital up front for these things, or most of the time. And it's important to understand this when you're explaining it to an investor, saying, hey, here's the time frame of the investment, here's the total project costs, and you better know your total project costs on a project. So many people continue to think it's just rehab and your purchase price, and don't realize, the interest holding costs, the utility costs, the permitting and all the other stuff, the sales costs, and the prep for that, the staging. Like, there's so much that goes into it that you find even 10 years later, you're finding new costs that you didn't know existed, and you're like, again, another cost that just happened, and you don't, and in each market it can be completely different. Like, I don't do a lot in California, and I learned the hard way about school fees, and I was like, great, I had to pay $5,000 or $3,000 of school fees in the city of Garden Grove for adding square footage to my house, and you're learning these fun lessons and going, well, that wasn't in my budget, that's $3,000.
But you do that even on an addition.
An addition, yeah, it's amazing. Like, and it's interesting. Each city is different, and you have to understand how to navigate that city, and make sure your contractor knows that too. When you guys, Mike, and keep in mind, guys, this is a Q&A, so feel free to ask questions and things like that if you want to know. I'm going to just keep asking questions of them so we can do that. So I'm going to get one more, and I'll come back to you in a sec. So when someone goes through and they're borrowing funds from you, and they're trying to go through and flip a house, what are the due diligence do on those team members, the contractors and things like that involved, to know, hey, these guys know what they're doing? Do you guys ask for insurance and all that kind of stuff? And from the contractor, what do you guys typically focus on? I mean, you don't have a lot of liability as a lender here when you're doing that, but that's a big deal for that borrower, of course, right?
FBI background check. No. Nice. So there again, we don't do a tremendous amount. Okay, so we have them. We've got an application.
Okay.
We have them provide us with a bio of experience.
Okay.
And we're really just kind of interviewing them.
Okay. Do you interview the contractors and things like that if they don't have the experience themselves?
Depending on how complicated the project is.
Okay.
So and who the experience level of the borrower. Mm-hmm. Yeah. So, but not general. I mean, just like a kind of middle of the road fix and flip where there's nothing too out of the ordinary about it. There isn't a tremendous amount of due diligence. Like, you can go on, literally, you can Google names. You'd be surprised what comes up.
Yeah.
You'd be surprised what comes up. But that's really about it. I mean, it's really get to know them, talk to them. You just get to feel like, I feel like that this person is being forthright with me or not forthright with me. Or being evasive, and then you ask more questions, and then it's again, because we're in the first position, we really look to that property at the end of the day, and whether or not we think they can convince us that they can get it done.
Okay.
And again, we're and along with that, like you've already mentioned, we look at the budget. Can they get it done for that amount? Why do you think? Because I've had people too with $15,000 budgets. And I've questioned it, and I've seen people get it done for $15,000. But doing it all
themselves.
But it's not typical.
Yeah, and you can't do it for that, so you got to be careful, of course, in that situation, possibly.
If they show up and say Michael's going to be the handyman, he's going to do most of the work, then we're going to start asking questions. But if they're using actual. And
do you guys get lien waivers when you guys do the draws and that kind of stuff at all on the property, or does it matter to you because you're in first?
It's required by title.
Okay.
Sometimes we do. We have the right to require all that. So the way we're set up is we really want to be. There's so much competition up there. We want to be really fast and flexible.
Okay.
So it's the way we're set up is, hey, if you're doing what you're supposed to do, we can be real flexible. Oh, yeah, you know what? It's not quite $20,000, but you know what? You're almost there. You're in the middle. Here's $20,000 I was going to give you anyway. I'm not going to come out here next week to double check it. We can be really, really flexible, as long as we feel that we're getting the responsiveness back. Now, when we stop getting that responsiveness, then we start asking more questions. Then we start saying, okay, I need to see receipts, and I start seeing lien releases. So But otherwise, it would just absolutely draw. It would just bring the process to a halt. Like if we had to go out every draw and go, I want all your receipts, I want lien releases for all of this stuff. For every draw, it would just absolutely come to a grinding halt. And it's one of the things that people that do come back to us is like, oh yeah, the process of doing draws over at this other lender was like a nightmare, and I had to pay for it, and it took them a week to give me my money.
Yeah.
And we're typically turning draws around in 72 hours or less.
Right.
So yeah, it's just how we operate.
Yeah, we do inspections on our stuff, and then at the same time go out every once in a while, during the project. Usually not very many draws during a project. So if you go out, once or twice, or you get a bunch of pictures from them in detail, and you see the material going into it, a lot of times that can be adequate depending on the size of the draw. But we've had issues where the borrower accidentally, he pays the contractor way too much money up front, and they misallocate it because contractors don't know how to manage money. So you go give them 30 grand, and they go out and spend it on other projects or back labor or mismanage it, and their guys don't get paid, and they go put a lien on your property, and it becomes a big mess. So it becomes an issue. So we got a question over here, and I'll come with Will afterwards.
Okay, I have 2 questions.
Sure.
Points and interest.
Yes.
And do you go in on deals on the equity side of multifamily?
No. So the way our fund is set up, we can't do anything but first trust deeds right now. The investment fund that we manage, it's purely first trust deed money. We do have the ability to do some seconds behind our own loan, and it's usually just in a situation like rather than refinance the loan, like I was saying, if there was some cost overruns, if there was value to do it rather than recast the entire loan, we could do like an add-on second. But we're not we don't put second money behind other people's loans.
And on the multifamily aspect,
on multifamily. So on multifamily, what we do value add. So like for lack of a better term, fix and flip apartments.
Yes.
So distress. We're doing a lot of this up in Fresno. We've probably done 10 or 15 deals up there where they go into dilapidated apartments, fix them up, bring them up to market rents, and they either keep them or sell them.
Is that the same model? Knowing what the sale price is, going up 70%, 80% LTV on that, will you fund some of the rehab?
Yeah, so on that one, it's pretty similar. The analysis is a lot different because we're doing income analysis, but on purchase we can do no more than 80% on the purchase.
On the purchase price.
On the purchase price up front, plus whatever that rehab dollar is. Plus whatever the rehab dollars
So
are.
the draws on the rehab?
Yeah.
Okay.
Yeah.
Do you do out of state?
We do not do out of state. It's all in California.
Points and fees,
What are we charging?
approximately.
It depends.
Yeah, could be an attorney.
Depends.
Give me a range.
Yeah, I mean the range would be right now.
What's the low side?
Low side.
We typically do differently though. So many companies come out here and they'll tell you the very lowest you could ever possibly get, and you don't get anything close to that. So we give you our sort of high end beginner.
Yeah, so,
one, and then if we can do better,
so like to give you a range would be like 8.99 to say 10%,
Okay.
and points 1.25 to 2 points.
And it depends on the timing of the market. Like that's now when the market's thin. When the market is good at the bottom, you're talking about it used to be 12 and 3 across the board. So
And length of what's the term?
So depending on the price, so like on a fix and flip, I mean most of our loans are 6 months, but if they need 9 months or 12 months, we're typically not doing more than a 12-month loan. And even on like those apartment deals, we'll do you can get extension options. So on a fix and flip on a value add apartment building, same thing, usually 12-month loan, and we can do extensions on that as well. But the idea on that is it's not supposed to be a long-term loan on those apartment loans. You're either going to refi into a cheaper loan or you're going to sell it. Yeah, it's not intended to be a long-term loan.
And you can close as quick as you can on house.
I mean, I those apartment deals, I can. So in Fresno, like I've got that market wired. I mean, I've done so many deals up there. Like I can do my comp analysis real easy. So I can do one of those in like 4 days. It's a lot of work, but I can do it in 4 days.
it's a lot of analyzing.
So if we say 2 weeks or less, but I've like a lot of those, they're in the same neighborhood, so I can pretty much take my comps and move them over here. So I don't have to go through a big, huge analysis on it. So it's pretty quick, but 2 weeks or less easily.
Okay.
Yeah.
There's also, on the bigger stuff, I mean, that's great to take it down a lot of times, but a lot of times it might be good to, you take it down with the private money is going to be there for you in 2 weeks so you can get the deal you want, and then a lot of times, the banks take a long time sometimes. They can take a month or two to get these things done, but that's when you can go out then and maybe get the construction loan piece or something like that from a bank afterwards to take out, the quick money that's going to get you there and get you that deal, which is important,
So we'll do bridge loans like that. I have people that come to me and just because we can close that fast, and just like you're saying, it might take them 60, 90 days or more to actually get a conventional loan. And it could just be a house. It all has to be investment property. I can't do any owner occupied. Because maybe wants to buy a house for rental. Maybe it's a fourplex, whatever. And he goes, I can get 6% money or 5.5% money, but it's going to take me 90 days, but I don't want to lose its property. So we go, okay, we can close on that. And again, if we have to, if you've got what we need, we can close it. We literally closed a deal on a Friday. We closed on a Monday on a deal. Now I got everybody in the company involved to get it done. But and it's not like something we like to do. But I mean, if it's got to get done and we like the property, we're going to do everything we can to get that thing done.
And it's interest only?
Interest only, yeah.
And the interest charge is only on as you release the fund.
It's on the full loan amount.
Full loan
Yeah,
amount.
full loan
Okay.
amount.
We'll come back here and then we'll come here and here.
You were talking fix and flips, but this would go for fix and holds as well.
Yeah.
You answered it.
Okay, yeah. Cool.
Question here, and we'll come over here.
Oh, it's not a question. I just testimonial. I work with Trillion, with Mike and Karen, and they're like, we had a property that we were finishing in December, but I didn't want to list because it's almost Christmas.
Yeah.
So I told Karen like, hey, it's done. I come look at it, and it's not in their policy to pay unless it's listed. And she surprised me because she's like, we can't do it. And then she emailed me like, hey, Merry Christmas.
Nice.
Money was wired,
Yeah, I gave up. I asked her like, can we do this? She's like, no, it's not possible. It's not our policy.
We'll fight for you. We'll go
Yeah, and then like she was like, she didn't promise. She actually said like, no, don't even try. So I'm like, so I went off on my vacation and I saw this email. I'm like, oh my god, yeah, Merry Christmas. Yeah, so thank you, Tommy. Yay.
That's awesome. Question here?
So, Mike, excuse me, what does it mean to you if a second position lender wants to sign a deed in lieu for that property for his money? Does that mean anything to you?
Well, I got to think about that. Wait. Okay.
So wait, the second borrower wants to.
Well, the private money guy was asking me for a deed in lieu. I'm against him because what if we're digging a pool and I strike oil? I want a mineral rights. But I mean, there's something really different. But he was asking me. He said, I want a deed in lieu if I give you any money on this. I thought.
Oh, so
what does that mean for the first?
That makes it okay.
Is that something you would walk away?
I don't think that's even enforceable under real law.
Yeah, I mean,
so.
he's got to wait in line, but.
I don't even think
So
that.
So you would give title of the property to the second?
If we get into a
They're
foreclosure
saying having-
situation.
But the second, you're talking about a situation where the second would foreclose.
Right.
You give him a deed.
He's saying if the second basically wants to lend the money, then you sign a pre-deed up front basically for the attorney to hold or something like that in case there's a default and they can just record instead of foreclosing. But I don't even know if that will actually be legal. You'd have to talk to an attorney specifically, but I don't think that would actually. I've talked to certain ones about that because I was looking at can you do that? Because that'd be great, But at the same time, I don't know that. It's enforceable necessarily. Depends on the state law, probably. So
yeah, I mean, so just a few things. If they were to do that, the property would still be subject to our loan.
Right.
So our loan wouldn't go away.
right.
But anytime, unless we give you permission, you can't change. You can't retitle the property. You can't transfer title without our permission. That's an event of default. And we could do
Do on sale clause.
do on sale, call it due if we wanted to. But we've had situations on workouts and stuff where we do that all the time. So, I mean, that's all I can really say. I never even thought that through before.
Once it goes into default, I think you're in easier position to do that kind of thing. But you're talking about doing it before he even signs the loan. You're not in default and just signing it, right?
I think they call it a drawer deed.
Yeah,
It's a deed
yeah.
that sits in the drawer.
So I mean, kind of along the same lines. I mean, we've had seconds that have filed an NOD before we have. So the reality of that is, so if we were just, we may or may not, we'd probably file an NOD behind them. In fact, we would. So, but they could go to auction first, and if it doesn't sell, then they end up with the property, the second.
Yeah.
So they end up with the property subject to our loan. So we're going to the second saying, you got to pay our interest now. So then they've got to take and find a way to sell that property.
Yeah, the conversation I was having is if it defaults, he was going to go straight to you, pay you off, and then take the property and sell it.
Yeah, and we've had people do that because the second, the borrower, we had some problems where the borrower turned out to be shady. And the person that was the second was on multiple properties. So she filed NODs on all of them because she felt like she had to protect herself. And she did end up getting the property back. And she paid interest to us for a few minutes while she took some time to relist it and sell it. And she did, and she mitigated her losses. So, and we worked with her through that process.
And it's interesting because I've done some seconds like that, and every time I do a second, if it's a small second, like we've had people, because the deal was thin, they take over the existing loan from the homeowner, make it current so that way it's a couple $1,000 there, but then that's really low interest, on that loan, so I'll bring in a second or something like that. But I always do interest holdbacks on my loan and the first, so I can make sure that it's getting paid, where they show me it's paid every month and I reimburse them for that payment, for the entire term of my note, usually in a second position like that, which, can hurt if it's a couple $1,000s a month in a payment or something like that. But at the same time, it's the way I protect myself if I'm putting myself in second position on something, So, but it's definitely something there's always little ways to maneuver, hopefully, So, but knowing that first is getting paid is very key, because you could be completely wiped out. And, a lot of people deal with private investor capital in this case that's not necessarily sophisticated. And so you want to be really careful. And, if you do something where it's not by the book with any of your private lenders that you're raising money from, you're training them wrong. And if you train them wrong in the first place, then they're going to be set up for failure in the future when they meet somebody that maybe isn't as honest as you, that maybe isn't going to, save you if something goes bad or something like that. So something to think about. But any other questions here?
Can you repeat that again? What was it that you put for seconds?
You're talking about the interest holds?
Yeah.
Yeah.
How do you get them to disclose if they're paying their first?
I make them show me the payment that they made out of their bank account, or show me the actual, interest that they paid. I want to see that payment. So usually that's how I do it. And when I'm doing construction draws, I will go through. I have an Excel sheet because I'm a CPA and love the Excel stuff. I'm like, fill this out. I want to see everything you paid. You're going to give me the date. You're going to give me who you paid it to, and you're going to give me the category that it goes in, and it flows right to their original bid and allocates it exactly where that was supposed to go based on the category. And I'm like, every draw, show me what you spent right here, and they send it to me. And then of course I'm like, well, let me see the pictures that go along with that if I'm not going to go out there. But when I do go out there, then I can see what's really happening. But I make them submit that Excel sheet to me. It's a pain, and a lot of them see this Excel sheet and they're like, I'm scared, I don't want to look at it. And I'm like, look, be careful. It's profit calculator, rehab calculator, funding calculator, right here. You're done.
How much training does that take for you?
I have a 10-minute video that I just like, watch this, do the Excel sheet. And usually, the first couple times I'm working with somebody, they're like doing it wrong and messing up a formula. I'm like, look, gray means don't touch it, it's formula. Green, fill it in. And they still are like, I filled out the wrong things. And you're like, great. You're like, how do you not get don't touch the gray? So, but after realizing that my biggest risk was them running out of money and not having enough money for a project, or, the overages things you're talking about, and knowing I have an adjustments column every time you're going through. So let me see the change orders or major adjustments. It can be very, very key when you're analyzing these things. So
There's something very similar.
So tell me a little bit about how's the market changed from the bottom of the market to the current market now, as far as rates, terms, underwriting guidelines, the profit on a property, and what the strategies were then versus now, and that kind of thing.
Well, yeah, I think you alluded to it earlier. I mean, I didn't get into this segment at the bottom, but I know that, I think that we were charging 13, 14% interest and 3 and 4 points, at the very bottom.
Right.
So yeah, just as a cycle matures and gets, as it's healthy, as you're kind of going up that curve or whatever towards the end of the cycle, it's, it gets more and more competitive. In the beginning, nobody's in that space and people are looking for loans and not that many people doing it. Well, then everybody just jumps in because, it's fairly easy and it's a commodity product, right? So they go, oh, well, I'll just compete purely based on price. And they'll jump in. And so, yeah, it's gotten a lot cheaper. I mean, I've heard some people quote like 8% interest in 1 point. But there's always more to the story. Not everybody gets that.
So we had one where there was literally being tacked on a point on the 31st day that nobody knew about until they started a few deals in. We're like, why am I losing 10 grand on every deal? Why am I not making what I thought I was going to do? Went back and read a little docs word for word. It wasn't in the quote, it wasn't in, but in the little docs on the 31st day they added, it's 8 and 2. It's not 8 and 1.
And
it's hiding it.
Yeah, and it also could be based on how much you're borrowing. So our program is really geared towards lending as much as we can lend.
Right.
So if you came to me and say, hey, Mike, I really don't need all that money. I just need like half what you normally lend. And that's a dramatically lower risk. I really wouldn't be able to compensate you and give you a much cheaper loan. It's just not how we're set up. But there's other lenders that can do that. If you don't need 70% LTV, you only need 40% LTV, maybe you can get 6 or 7% interest. So, because it's just such a low. So everything's just kind of case by case. But yeah, rates are definitely coming down. And I think too, because it's been slow. I mean, we're still doing business, but it's slowed down a bit. It's been weird. Like I think we had their biggest month ever was in December. But
all the banks are trying to liquidate their inventory. Or?
I don't know, but the 2 months before that were fairly slow from what we've been doing earlier in the year, and then the last 2 months have been somewhat slow. But then all of a sudden the phone started ringing again a lot. So, it's real lumpy, and there's still a lot of money out there, looking for deals. But I think we don't want to get like so super aggressive that we're making stupid loans.
Right. Right. You don't want to have to do it, and all that. Right.
And then if the market were to turn negative enough to some point, or the rates got low enough, at some point some of that money is just going to pull out because they can redeploy that
somewhere else.
And higher rates someplace else.
Right. Are you when as far as the bottom of the market, what were the types of deals that were happening then versus now? You had mentioned I think more cleanup type stuff and resell. And how do you gauge that when you're underwriting a deal? And it's something if you guys are borrowing capital here, how do you gauge? Hey, this person is planning on doing a quick flip on this thing. So what's the market value versus the fully fixed up deal here? And I've had borrowers come to me and say, oh yeah, I'm only going to spend $5,000 on this thing. I'm really not. I'm just going to clean it up and do a hotel where you're not wholesaling it off, but you're going to go relist it on the market and clean up the yard and junk it out. Get rid of the stuff, and that's all they're going to do there. How do you underwrite something like that? Do you have to go and take into consideration what the full rehab bid would be the market value? Or
if somebody were to tell me that today, I get those calls.
Yeah, and I know someone that made a good friend that's experienced who we wouldn't do it, and she made great money on it.
Yeah.
It wasn't something we.
So again, if it's somebody we don't know, then we have to ask a lot of questions. I'm like, really, and in some cases, maybe for some reason they were able to pick up a deal that's in decent shape, and maybe they only need to put $5 to $10,000 in it.
Right.
But I'm looking at the other comps out there, and if they're tricked out and would look like they've got a dramatic amount of money in it, and he or she's talking about putting $10,000 into it, and the property at face value doesn't look that great.
The same as the other one.
I don't get it.
Right. And I think that's important. Understanding hey, this is a full amazing house, and therefore this would be the rehab on this property to get it to there, to be able to make that comp accurate, and then backing off your numbers and saying, well, this is the max I'm going to lend on this because of the fact that, I don't care if you're only going to put $10,000 into it. This is what the rehab's going to take, and really counterbalancing that. So.
Yeah, and we could still probably do a loan on it, but we're just not going to lend as much on it.
Right.
The ARV wouldn't be in
Well, the ARV is almost the as is value, right? It's the as is plus 10. I mean,
right. Question here?
Yeah. Do you find somebody wanting to add like an ADU on a property? Do you find like new construction?
We do new construction. The thing is, so we have to be in first position though. So if you already got a house, and it has to be an investment property, it can't be owner occupied. But if you got a house, if you have an investment home and you wanted to add an ADU, more than likely you've probably got an existing loan on there. We wouldn't be able to just fund a loan for just the ADU because we'd be in second position behind that other loan. So if you're in a long-term loan on there, you've probably got really cheap finance. Or if you got a traditional mortgage, you could be at 3, 4, 5, or 6% on that. You wouldn't want to replace that with short-term money for us to come in to be in first position and lose that existing loan. So
We do have a ton of people though who are doing ADUs with their rehab.
as part of it, yeah. Oh yeah. So if you came in and said, yeah, so for sure, if you came in and hey Mike, I'm going to flip this house, I'm going to add an ADU. Yeah, absolutely, all day long. Yep.
Yeah, and I think that's, if you're a homeowner, for example, and there's legal differences, obviously, when you're lending to homeowners versus flippers and investors or not owner-occupied people. And so, when you're going through and trying, if you're a homeowner trying to do an ADU, maybe better just to do a home equity line of credit or something along those lines to try to get the money together to, add the thing first and then refinance afterwards, as well with the higher value if you can, or use different creative ways to add that, get that money.
And I'm sorry, I understood the question initially, but yes, we do a lot of properties where they add an ADU, either whether it's detached or like a garage unit that they'll turn into, like they'll classify as an ADU. Or let me rephrase that. It could be a detached garage, and they're going to say that's already exists, and they can convert that, and they also do ground up ADUs. That's what I'm trying to say. Excuse me.
Do you think of some properties that have been rezoned? Let's say you buy a home and it's now rezoned for R2, and you want to do a duplex out of it. You would go on something.
Mm-hmm. As long as we're in first position. We've done other stuff where it's a big lot. There's one home. And the guy says, I'm going to buy it, and I'm going to split that lot. And I'm going to rehab that house, and then I'm going to build a second house behind it. There's ways for us to do that, too.
Because it's technically now a second property and things like
Yeah,
that.
so there's only so much we can lend until that lot is split, so the loan might be broken up into different pieces, but there's ways to do that as well.
And typically on those types of things, you obviously do like a year term or something like that on something, because you got 3 months or 4 months worth of permitting at least.
Well, yeah, depending on the jurisdiction, just splitting a lot, that could take you a year.
Yeah. Especially in California.
Yeah, you just never know, depending on the jurisdiction. Absolutely, it's just the time frames vary wildly. It's just
if you're doing any kind of major addition and things like that, you really need to go talk to the city first and understand the timing of this so you can compute your interest correctly, because people run into major problems down the line trying to get that in California. I have a builder friend of mine that moved to North Carolina to do building construction because he was sick of California's regulation with regard to building. So it could be a crazy thing if you don't know the city, the people at the city, or the code enforcement. So, got a question over here?
Yes. So in 1 week's time, I'm closing on a property in Cleveland, and it fits the perfect criteria on a wholesale deal. Originally, I just wanted to do an assignment, but I had many tenant buyer inquiries on this property. Again, it only needs about $3,000, just looks like on the page. I have a project manager out there. Would it be possible to close on it? What would your sentiment be as a lender if someone's plan was to refinance, pull all the cash out, and then install a tenant buyer just with the option to purchase it after 1 year or 2 years?
Okay, so and did you say it was a hotel? Is that what you...
Hotel. He's talking about just barely fixing it up and then selling it to a tenant buyer that might buy it in a year, basically.
So we don't typically do cash out. So that and I'm sorry, I'm kind of hard to hear it. So you used to say hotel.
No, hotel. So meaning he's basically just barely fixing it up instead of wholesaling. They're just putting it back on the MLS, barely fixed up.
Okay, so wait, it's an apartment? What?
It's a house, right?
It's a single family home.
Oh, single family. Okay, I'm sorry. I don't understand. Okay, take me through that again. I'm sorry.
So again, there's not enough time. Basically, I initially just wanted to do an assignment.
Okay.
And I realized that investors were lowballing.
Okay.
for this house that's in excellent condition, it's 50 grand discounted probate deal. And I built, while I was marketing the contract, there was many tenant buyer inquiries. People who, they don't want to purchase it at retail price, but they're willing to put in sweat equity in. Let's say someone tried to do something similar in California, where they want to refinance, they want to purchase a property, refinance it, and then install a tenant buyer who's going to exercise their option within a year or two.
So yeah, I think basically in that kind of situation, you're looking at, if you're talking about a California property, for example, for his stuff, or any hard money lender would do the initial purchase for you. They wouldn't necessarily do the refinance unless it's at a really high rate. And if you're going to go through and do the sale to an owner occupant afterwards, it could change the metric where, if you would just use the refinance that you have and do a wraparound mortgage or something like that. But of course you have to do on sale clause on your mortgage, on your refinance. But most of the time, someone like Mike is
mortgage to the.
Okay, yeah. So if it's a lease option or something like that, you're talking about you own the property now, and you took out your private money, your hard money lender, or your private money lender here, and now you're refinanced with traditional or something, or maybe another private loan. Usually those private loans are still going to be at a higher rate. It's not going to be like bank financing rate. You're going to be at like 9 or something like that. At the worst case scenario, or probably at the best case scenario actually in some of these markets. So if it's an investment property, and then you're just waiting for them to enact the lease option to purchase. I've found that 95% of the time they never enact the lease option. So in those kind of situations, you're not going to go. They're not going to buy the property like most of the time. If they put a bunch of sweat equity in, there's a reason why they need to go to your financing in the first place. Or have that kind of option because they don't have the credit or the money or to do that yet. But if they're putting the sweat equity in, great. You're in a great position because they just made the property worth way more. But at the same time, they're just putting it in for you. But from a lending perspective, most of the private money lenders like Mike are only going to be doing, max 1-year loans because they're in the business of this. If you're using it to fix it up or something like that, great. But if you're trying to refinance afterwards for something long-term and wait for that end buyer, usually the private money lender is not going to be the person unless you're going to private relationships that aren't professional lenders, So, because he's going to be in the business of moving that money quick because he doesn't want to take the downside risk of the market and hold it for 2-3 years or something while you do a lease option.
It wouldn't be possible to just have it, let's say, amortized over 10 years, but have a balloon due like in the second or third year?
I mean, it could, but at the same time, you're talking about, a higher rate and you're probably not positive cash flow, So.
Unless it's at a deep enough discount to where the fair market rent would be like $1,200.
Yeah. Right. If it's interest only, makes it cheaper, that kind of stuff. So,
Thank you.
hope that helped, Mike. I know it's out of state in a different scenario.
Yeah, no, that's fine. We keep it real simple. That's creative financing. We wouldn't be a fit for you in that situation. So.
But the creative financing stuff can be awesome too sometimes. I mean, that's what he was talking about when he was doing the building stuff, where he's bringing the equity piece in for this stuff and finding ways of partnering and doing different, kind of joint venture deals with people. And so that creative financing can be really, really valuable if you know what you're doing on that side. So, but you've got to become a specialist at the financing piece, right? So, any other questions? Everybody's scared, huh? I know you guys all need to learn how to raise money. Come on. So, all right. So, you said again?
Let's raise money.
Yeah, I know. So who when you're going out to these different, borrowers and seconds to complete these deals, you got the relationships in the room to take down the initial piece. When you're going out to these different private money people, find the deal, make sure you know all your metrics, make sure you can actually go through and document everything about that deal, just like you would have to do with a professional lender, and take that to your seconds or to your different relationships to raise that money. Keep in mind, there are lending laws and things like that in California that you need to be very, very careful with. And, if you're doing it perpetually, and you could have servicing laws that you have to be careful about. You could have mortgage broker laws that you have to be careful about, especially if you're doing it over and over again. Can you talk about some of the rules here in California with how, as far as lending money? I know it's generally he's not an attorney, so, type of deal, but
to the extent I can speak on that, because that's actually not my area of expertise. So
okay.
we do not, so everything we do is business purpose loans. We do not operate under the consumer mortgage, consumer financing. So we fall under we have a CFL license, which falls used to fall under the BRE, and actually now I think it's under a different entity. So the rules for us are really much simpler than if you were like a mortgage broker trying to do a mortgage on a primary residence for a homeowner, and that's why we can fund so quickly. But in terms,
standout though, because we will lend to a person. You don't have to be a company or an entity. You can be a person, but you sign something that says it's a business purpose loan. And most of them need you to be an entity.
Right. Yeah. So we can lend to individuals, but it cannot be your primary residence. We have you sign additional paperwork that says, "Hey, this is for investment purposes only, and my primary residence is over here, not here." So there's two pieces of paper that we have you sign.
There's for those of you guys who don't understand, there's different laws for homeowners, obviously, homeowner loans, because there's consumer protection things in place. When you hear about the Wells Fargos and, some of the big banks that were getting in trouble for their, predatory lending in certain low-end areas where they just had massive foreclosures because they were doing the bait and switch and that type of stuff with 5-year or 3-year balloons where the payments tripled in certain areas. Like, this is why these laws were put in place and in the first place. Plus government overreach and all that stuff. They always knee-jerk reaction 100% the opposite way. And what they did with Dodd-Frank, they basically got rid of or made it harder for the private lender to actually do this. You have to have like a national mortgage or mortgage license originator license, and I think it's a national mortgage license originator license as well. But you have to have these different licenses in place to do it, and most private lenders or seller finance type deals and things like that don't have that kind of a license. So it cut out a lot of the private lenders when you're going to homeowners directly, and made it so that it gave it a kind of a monopoly to the banks. In a lot of cases, there's ways around it. You can go through and hire a licensed lender to do your complete underwriting if you're going to loan to a homeowner. You just need to make sure that you have the right pieces in place and the right licenses in place to do that, so that you're not the one originating that loan to the homeowner in that case. You're more actually acting as an investor in that case. And so, but when you're dealing with non-owner occupied investment property for commercial purposes only, which is the key, that term, the commercial purpose only piece of it, they're signing away saying that, I'm not going to live in this property, and if you do, I wouldn't be doing this loan. So that way you don't have to deal with, the typical owner-occupied lending laws. And so, there's a lot more flexibility when you're dealing with business purpose loans.
So the paperwork goes from this much to like that much.
And the liability too, from a lender perspective. So, question
Can
here.
I sidestep all those regulations if I just set up a general partnership with my private lender?
Oh, I'm not an attorney. But so the structuring component of this, like for example, for us, we're bringing in for California. We don't do any lending in California, but just for a coverall, we're bringing in a broker to hang their license with our entities that are lending capital in other markets, just to have it here with the California finance lender's license and all that stuff. And so, you got to talk to a specific attorney about your structure individually and what you're trying to do, because each one is a little bit different, right? And so if you're doing homeowner loans or investment property loans, you still want to be able to be licensed correctly and stuff like that. So, but it's really going to be dependent on what you're trying to do specifically. But there are structures where you can technically be a licensed lender if you have the broker and the licensed lender with your LLC or your entity. So, question here, Clint?
I think Mr. Ross was supposed to talk about that, right?
Yes.
But he didn't make it.
Dennis was going to be here. He's actually my lending attorney, and he had a viral infection, and he had a tweak to his face from the viral infection. So he was worried he was going to scare everybody here. And so he was like, "Okay, I'll come later on," but he was the one that was telling me how to structure my stuff the exact same way you're talking about with. Look, I own a brokerage in Tennessee, for example, but I'm not a broker in Tennessee. But I own the brokerage because the broker hangs his license with my company, for example. Same thing can go here as well. Now, there's different rules about what I can do or what other people within the organization can do if they're not licensed. So you got to be careful there. But that being said, it's doable. You just have to have the right legal counsel to tell you how to do it right, and that their liability insurance. So you guys go out, and who do you guys use right now for your lending stuff, your attorneys and stuff like that? So is it Geraci?
It is, yeah, it's Geraci. Yeah.
Geraci. Okay, so there's some big law firms that do this kind of stuff. Geraci is a good one that I hear recommended. Dennis Doss that does mine, he's recommended by some of the top guys in the industry that know what they're doing as well. So, and I spent a lot of money on legal compliance work before I found the right lending attorneys that already knew, that are like, oh yeah, could have done all that legal work out of state for you for, it's already done. It's $3,000. It's all done for you. And I'm like, great, I just spent 15, on all this other stuff. So there's definitely things to be careful about when you're dealing with different professionals. So that being said, we're getting close to 9 o'clock. I want to finish off with some of the biggest challenges you're seeing right now in the real estate industry and with the lending business, and maybe in your career that you've gone through, and maybe a deal that didn't turn out good, or some of the nightmares you've had to deal with. And because a lot of this is problem resolution, right? It's how do you solve a problem, because the problems will come up. So
yeah, I was trying to think of horror stories, and
How about Arden?
Yeah, so nothing.
I don't want to talk about that one.
But it was like I couldn't believe I couldn't come up with like something more horrific. So we had. There's always problems, and we're always working through problems. But we had. First of all, there's a lot of wire fraud going on. If everyone's not aware,
we're real careful with that.
It's amazing, like all the wire. We haven't gotten burned by wire fraud. However, we lent on a property where it turns out the seller was not the seller. And we lent, and luckily we didn't lend a lot of money on it. I think it was less than $200,000. And we got our money back from title. But
if it's a big claim, title's going to fight you.
There was some sort of scam going on with the people living there. They convinced our borrower that was buying the house that the person that claimed to be, there was a tenant living in the space, so they got access to the property. Mm-hmm. Somebody else claimed to be the owner. It got past title, got past us, got past escrow, it got past the buyer, and maybe like 3 weeks after we closed, we get a call from the borrower. He goes, I just got a call from the actual owner of the property, like, we didn't actually buy that property, or it was sold like out from underneath them.
Wow.
And so anyway, so it was a big mess. I thought, the title company's never gonna pay, right? But they did actually, and it didn't really take that long. But it was just scary, right? Because we didn't know what was going to happen.
Right.
And it was literally, I think it was maybe $150,000 to $200,000. It was a small condo in Inglewood.
If it was $1 million, they might have fought you a lot more.
Yeah, we do stuff in Beverly Hills. What if that was a property in Beverly Hills?
And this is the importance of your team members, your title companies. We've gone through and went through different title companies in different markets where they don't catch a title issue, or someone that died that signed something after they died for something, or there's things like that occur. And so it's really important to understand the skill sets of your title company to know, do they know what they're doing when they're looking at your title? How thorough are they? Because a lot of times they're not that thorough, and you want to make sure that team member is really good. And I've heard horror stories from title insurance companies where I had a client that bought like a $3 million property, that had like an easement on it that wasn't disclosed, and they couldn't access, there's an easement on the neighbor's property to access the property, and they actually couldn't get to the property, and it was like a big problem, and there was a big, $2 million loan on it that the borrower was obligated for as well, and the property was technically worth like they bought it for like $3 million and got title insurance for $3 million, but some of these title companies will literally go hire every title attorney they can find at some point in the process so that those title attorneys can't represent you against them. So they go and find everyone that they can to do that. And so it's kind of, you're talking about $1 million stuff. So make sure when you're buying these big buildings that you know that they are looking at every detail. I would even look at the title myself. They've caught things where, I'm going, wow, that double L on the signature looks the same as the wife's signature, and they found out that they signed after they died, and there was a second on the property that really should have never been wiped out, and now you've got a quiet title issue that can take 2 years to clean up, and then what happens if you're in a short fix and flip deal and all of a sudden you're like, great, you have a personal guarantee or something on that loan, and all of a sudden you are stuck holding the bag, So be careful about a lot of that stuff and do your homework on these deals, because that's, he's lucky it was only $200,000, So I say only scaringly, being scared.
God, I had another one too, and it just escaped me. It was kind of along those same lines.
What city was the first one?
The one we were just talking about? That was Inglewood.
So he has a similar experience.
By the same person.
Oh, same thing happened to you?
Oh.
Wow. Oh, geez.
The bank is, they were only able to take $15,000. They went to the bank, and the bank is who they said something wasn't right. And when they told them to hold on, they got paranoid and they left the bank.
Oh, wow.
Then the bank called escrow and said, something's going on here. You better look into it. Then the investor and myself did more due diligence, and I went knocking on that person's door. And I spoke to the actual owner and myself.
Wow.
We got everything completely closed, everything.
And with
It was 15,000 of the amount that was wired for them.
All right. I just remember this one. Okay, so I was on a property inspection. So we did a refinance, and it was West Hollywood. It was a big property, probably like 2.5 to 2.7 million after repaired value, and there was all these loans on this property, and we refinanced them all off. So I was out there doing an inspection. The borrower was there. He just so happens to get a phone call. This is like 6 months into it, and he gets off the phone. He says, "So that was the one of the subordinated lenders that we paid off when we refied." So they said they had never gotten paid off. So when we refinanced. Our loan was to pay off all of these other loans, so that we would be the only lender on that property.
Be the first, yeah.
So the second was calling and saying, "Hey, we never got paid off." So we've got title insurance, so I'm like, well, holy crap! I'm going to go back to the office and just make sure. But sure enough, our title policy says we've got it fine. Mm-hmm. What had happened, and it wasn't just this one property. The other lender was a private lender, and he also had seconds as well as firsts, and he was scamming investors that were giving him money to lend in seconds. They were lending into one entity, and it was not the actual lending entity. So when those loans got paid off, they went to the owner of the company, and those investors did not get paid off.
Oh, so it's almost like they didn't get their lien waivers, but
so they got completely ripped off by the owner of that company. And then a month later, I got a phone call from the borrower, and that guy, it was basically a house of cards. He was like a Bernie Madoff. He ended up committing suicide because this was happening like across the board on dozens and dozens of properties, and he was going to go to jail.
Wow.
Because he was defrauding all these people. So
that's crazy. That's crazy. Yeah, the wire fraud thing is a real deal. You guys, every time you wire money, call to verify that wire, because they will stop your email, stop the wire email with the wire instructions, and literally go through and put a new one through to you. And so, usually a lot of title companies are sending them all the wire instructions through secured emails now and stuff like that. So if you're not getting them that way, we've had instances where we get a second email from the title company giving us their wire instructions, and it's always they're seeing it a lot. They're seeing it a ton right now. Be very, very careful. Question here.
Yeah, I had a similar experience for my business. We work with China, so they were sending us an invoice to pay for goods. So it was weird. It was the second. We worked with them several times, but this bank was like a UK bank, but it's like her email. And so I was like, okay, so you changed your bank, and it happened. They hacked her email, so we didn't know that. So we wired money to a bank account in the UK. She called me that night. She's like, hey, where's the funds? I'm like, I just sent it. And she's like, oh my gosh, that's not my account.
Oh no.
But luckily, it was like the Royal Bank of Scotland. They're the only bank that had like a 24-hour fraud department. And the bank hadn't opened it because it was like in the middle of the night.
Oh wow.
Here.
So they didn't like
So
wire.
they couldn't take it. So I called them in the middle of the night. They're like, okay, we're going to freeze that bank account. If no one can touch it until we investigate it. So
Awesome.
if it was the morning, they would have already just withdrawn it. It's like 30,000, but it's still.
Yeah. Wow.
So the email part, like, that's why I always wonder, because escrows, those email, someone can hack that.
Have to call. You have to call every time.
Secured ones now, there's just no reason not to, I just call them all.
Yeah. You just do it as a procedure, every time. So, well, thank you guys very much. Let's go ahead and give Mike a round of applause.